Aditya Birla Sun Life Banking and Financial Services Fund is a sectoral fund, thematic fund which invests in banking and financial services companies. One very clearly understands that there are higher risk when you look at concentrated sectoral funds. Generally, what we do in banking and financial services is it's a gamut of multiple sectors within the BFSI space, where it has large banks, smaller mid-sized banks, private banks and public banks. Then there are insurance companies which also has life insurance, general insurance. There are other lending organizations like NBFCs and housing finance companies. Within the capital market space, we have few segments which is like mutual fund industry, which is asset management companies, then broking houses, and also depositories and other companies. So all in all, the sector looks to be very diversified within the gamut of banking and financial services sector. This seems to be a fairly interesting question. I've been managing now this fund for close to 9 years. And if you look at last 9 years for Indian economy or Indian markets, there has never been any 1 or 2 great or straight years for markets as a secular bull run. There was times like demonetization, there were times like GST implementation, slowdown in economy, then a big bang COVID related pandemic happened in the country as well as hit the markets very hard. So generally BFSI sector, if you look at, is a backbone when it comes to of economy and the growth in the economy. Therefore it has higher beta, therefore the volatility within the sector remains to be very high during a lot of challenges which the sector or the economy sees during volatile scenarios in the markets. So generally there are a little bit of high volatility when it comes to fund, but as I mentioned, right, that there are diversified sectors within banking and financial services sector. So there are companies which are like in the insurance or asset management or capital market place, where there could be more structural companies. Within the banks also there are few banks which are the large private sector banks which has been running or growing at 17 to 20% secularly despite whatever problems I just mentioned. So we need to find pockets of growth as well as secular growth within the sector. So if you ask me a question more simpler, this is a highly cyclical sector as well as more regulated sector, because there are many regulators regulating different parts of BFSI. Overall, we've been able to weather the storm of volatility very well when running Aditya Birla Sun Life Banking and Financial Services Fund. As we are discussing Aditya Birla Sun Life Banking and Financial Services Fund, this is a sectoral fund. So definitely investor needs to understand that this is going to invest in one particular sector, therefore it would be a little concentrated and a thematic in nature when it comes to investing. So, and it also comes with a little higher risk because of the domain of sector investing only in a sectoral point of view. So the good part about this fund is that it's predominantly large cap oriented, because largely the companies we invest in the banking and financial services space are very large companies from an economic and from a market cap point of view. And we do also invest in very small size companies. So there is a complete bouquet of investing across market caps, but predominantly it's a large cap oriented. So definitely it could be having a volatility, but the bounce backs are always very faster. Now answering the question, how much percentage points, maybe depending on the risk appetite of investor, it could be between 10 to 20% in current juncture. We are fairly bullish, therefore I think it could be even a higher allocation for a retail investor depending on the risk appetite. Basically, this is a very important question. We've been managing this fund now for close to 9 years. There are a lot of SIP holders of this fund, and I keep answering the same question to them, is that if at all you don't need money for another next 5-10 years, you can remain invested. You can even continue SIP in this fund, because as I mentioned, Aditya Birla Sun Life Banking Financial Services Fund is a focused financial services fund which invests in companies which are largely economic growth oriented. So what do we understand is that these companies can continue to deliver growth which would be over nominal GDP over a period of next 5 to 10 years. So investor with an horizon which is 5-10 years could continue investing either in the form of SIP or continue to invest lump sum for a 5 to 10 years perspective. Also, today as we are discussing the sectoral fund thematic, one can also look at opportunistically, because last 2 years have not been up to mark. There could be mean reversions in valuation multiples, and therefore you should increase allocations at this point in time. If you look at today, banking and financial services sector is very well poised. One you asked me about is what are the key fundamentals one should be looking at. So today, if one has to look at last 2-3 years have been very challenging for Indian economy. One, because of slowdown which was there in 2019 and early parts of 20, and then coronavirus or COVID pandemic hit the country or the globe, and therefore there was a tremendous slowdown in the economy and the GDP. So, and as a sector has got hit directly, materially. There has been a lot of NPL creations, the non-performing loans creation because of the slowdown in the COVID cycles. More importantly, we are behind this impact now. The asset quality cycle from current levels looks to be fairly benign. So asset quality in the sector, especially the banks and the lending organizations, are utmost important, because the business is all about getting the money back and then achieving profits. Today what we see is that we are in the new credit cycle, possibility of next 2 to 4 years of a very steady credit cost or reducing credit costs. Credit cost is generally a term which we use, which is provisioning, which the banks or NBFC companies do in their P&L for loans which are not recovered. So ideally what we see is that their growth could improve. We are expecting 12 to 14% of credit growth for the sector. Credit cost to reduce, so there would be higher profit growth than the top line growth. So net what we are saying is there could be a good years ahead where profits could actually double for the sector in next 3.5 years, because we are coming off a low base and a very benign asset quality cycle. So that is about why we are very bullish, or what are our fundamental stance on the sector. Apart from pure lenders, which I discussed, there are companies which are insurance, mutual fund industry, mutual fund or capital market related companies, which are part of non-lending financials. That is the term which we call, which is more secular and structural in nature. The penetration level stories, if one has to understand for life insurance or health insurance or mutual fund products in India, they remain to be very strongly biased for upward trajectory, growth in the upward trajectory, and therefore we remain very bullish on these segments more from a structural point of view. So an overall point of view, today the timing seems to be very strongly biased that you should be allocating more money, or you should be considering Aditya Birla Sun Life Banking and Financial Services Fund for more investments. A fairly interesting question. Again, I would say this is a question which used to come almost 8-9 years back, that whether this fund will be private banks heavy or public sector banks heavy, because that were the two key components of market cap within financial services or banking companies. Today, after a long 1.5, almost as I mentioned, from last 1.5 years, we've been overweight on public sector banks in our portfolio. Public sector banks have turned around materially. Select for public sector banks is what I would mention, have turned around materially since last 5-7 years of corporate deleveraging or corporate NPL cycle. They now are returning back to close to 1 percentage point of return on assets, which is one of the key number which they used to steadily achieve between FY8 to FY13. So if at all the profit goes back to that level for every or the select public sector banks which we like, there should be possibility of valuation re-rating for these companies. They are largely trading at 1 standard deviation lower than their historical average valuation multiples, or materially below book value, one should be telling. And there is all possibility that improving fundamentals, they could go to close to 1 time price to book multiples. So therefore we remain materially bullish, but only on select public sector banks and not as a basket. Let me tell you something what used to happen 25 years, 30 years back, right? So I understand your question is pointed towards fintechs, but let me tell you how the sector has evolved. Maybe it answers few more doubts of all the people listening to me. In 1994, there were new bank licenses given by RBI, almost to 10 new contenders, new scheduled commercial bank licenses. Since then, there are many other NBFC licenses being given or awarded to many companies. So constantly what has happened is that the sector has always seen new advent of new companies, and largely most of these companies or lenders or organizations have been regulated by RBI. What we've seen in the last 7-8 years, especially in global countries, especially in the US, there have been a lot of fintech or tech companies converted or trying to do finance business, and therefore the name fintech has come. In India also there are various companies which have become very big when it comes to operations, also definitely become very big when it comes to valuations in the private markets in the fintech space. Now, whether the fintech space is important, fintech space is definitely important because they bring in tech element, and their key USP would always be of doing business in more easy manner for the retail consumer, and they bringing in a lot of cost optimization and better opportunity for the retail consumer. Now, that is what I understand about fintech, but definitely there would be a material different understanding everyone else would have, including the fintech companies themselves. If they have to become bigger, if they have to scale business, especially in the lending and deposit mobilization, they will have to come under RBI's stable, and RBI will regulate them in a similar manner as they have been regulating banks, NBFC companies or other organizations under its stable. So that is how what I feel in the long run it's going to be more positive if fintech companies, most of them, come under RBI's regulation. So see, generally what happens is interest rates keep moving up and down, or there is always a cycle of high growth, high inflation, and again there would be high interest rates to curb the inflation, and then there could be a period of little subdued growth, again lower interest rate, and again the cycle continues in that manner. Today what we are looking at it is rising rates are largely to do with improving growth and very high inflation coming from definitely external sources, which is the higher crude oil prices and higher commodity prices across the globe. Now the moment these things get under more control, there could be a possibility of steady interest rates or steady inflation numbers. Now, generally, a slightly rising environment is very positive for banks because there is one, demand going up, higher working capital requirements, so growth goes up. Plus, margins have positive bias because there's a more demand for money. And the second important thing is most of the banks have CASA franchisees on the liability side, so they get to borrow low cost deposits, which is current account and savings account, where the cost is fixed. And on the asset side, you are able to pass on the rising rates to the customers, so you tend to make little higher margins. So in a nutshell, what I would say is rising interest rate environment is positive for banking companies, especially the larger balance sheets or banks with higher CASA franchisee. But if at all it's not a hyperinflation environment and hyper interest rate environment, until then we would have a demand related problem, and therefore NPL related problem maybe few years down the line. So in this juncture it's positive for the sector. Maybe in times to come we'll have to monitor. So you asked me the question of long and short about interest rates and the view. Ideally, most of the banks which we are invested in our portfolio, right, they are largely long term oriented with a 3 to 5 year plus horizon, and the interest rate cycle will not matter when it comes to our expectations of these companies, able to deliver compounded 15-20% type of earnings growth. So the long one is very easy to understand that there is no problem. The shorter one I have explained you, the rising rates are actually more positive for the sector. So definitely what is happening with NBFC companies, if you look at, always in the rising rate scenario, they face problem when it comes to managing margins and managing their liability sides. And in the falling or when the interest rates are headed southward, they tend to benefit. This is a general perception, and which is a right perception, because of more to do with the ALMs or the asset liability mismatch they would have. Now, largely when we look at our portfolio at ABSL, Aditya Birla Sun Life Banking and Financial Services Fund, we are investing in companies which have a reasonably stronger credit profile. Therefore, the volatility in the interest rates are lower. Again, most of the NBFCs which we invest or we like are largely retail oriented on the asset side, and they have a prognosis of doing fixed rate loan books in a manner which is outside the mortgage books. So what happens is they need to manage their ALM well. Most of the companies who manage their ALM well do not have material downward pressures on net interest margins. So with higher credit profile and proper ALM, I don't think that rising rates should be material problem to NBFC companies also. There would be hosts of smaller NBFC companies who tend to take extra benefit during falling rate cycle, trying to make extra margins. They tend to make lower margins when the rates go up. So on an overall point of view, we do not see material challenges for the companies we hold in our portfolios with the change of rising rates. So as I mentioned earlier, see, Indian economy has been facing a lot of problems since last 7-8 years, in the spout of 1 or 2 years going down because of some or the other reasons. If you look at, India had a very big corporate NPL cycle between 2015 to 2019. And in between we had demonetization, we had GST implementation, we had economic slowdown, and then came the COVID pandemic. If you look at industrial credit growth in India between FY17 to FY22 has been low 3% CAGR growth. And when you look at FY8 to FY15 or FY17, the industrial credit growth was high 13-14% CAGR. So there has been this crux of challenge when it comes to credit growth in India. What we are now seeing is coming back of corporate credit growth for banks, and therefore improving growth scenario for both private and public sector banks and overall industry. So what we are expecting today is from the low single digit of 7-8% of overall credit growth in the last 5 years, which was largely driven by retail. In the next 2-3 years, we are expecting growth will continue in the retail segment, but corporate credit, which was completely down for the last 5 years, will come back to high single digits and ultimately go to 10-11% over a period of next 2-3 years. So we are expecting 12 to 14% type of credit growth for the period between FY22 to FY25 for the entire banking or lending sector in India. Definitely, most of the funds or our peer funds would have similar type of mandate as well as similar benchmarks. So there are few categories within the banking and financial services sector that there are few funds who have benchmark at NSE Bank Nifty, and our fund which has differentiation, at least during the time of inception, we were ideally first one to have NSE Nifty Financial Services Index as benchmark. Now many funds would be having similar benchmark, but maybe at this beginning we were among the first one to have this as a benchmark when we started Aditya Birla Sun Life Banking and Financial Services Fund. So the differential between maybe Nifty Bank and Nifty Financial Services Index is that one only invests in Nifty Bank Index only in banks. But when it comes to Nifty Financial Services, the way I've been telling, we are investing across the gamut of financial services, which includes banks, insurance, mutual funds, capital market companies, rating agencies, broking companies, custodians, etc. So the point, and the fintechs also. So overall, we are largely investing across financial services, which has element of both cyclical and structural companies. Therefore, one differentiation if I have to look at between other funds is this, that it is more holistic financial services oriented fund. And the second I would say is maybe is also depending on how one runs or how one looks at many companies. What we are trying to do differentiate is we are trying to not chase the cyclicality, but more try and put stocks or companies which can grow at 15-20% their revenues and their profitability. And generally what we expect on nominal GDP for next few years or next 3-4 years is 12 to 13% of overall nominal GDP growth. So companies which could outperform the nominal GDP consistently would be the style which could differentiate our fund versus others. So we do have two companies, part of the fintech space, which are part of our portfolio, which we bought last year when they got listed. And then, if at all more companies get listed, we would definitely be evaluating. We do expect that maybe in times to come, this space could become bigger when it comes to business operations and therefore market capitalization. As I mentioned, in the last 30 years, there is a lot of evolvement within the financial services sector, that private banks, insurance, mutual funds, lending organizations like housing finance companies, NBFC asset management companies, all of these have created their niche, and now they've become bigger companies within the pie of financial services market cap. So that will continue. The view for the remainder of the year, I would say, as I'm fairly bullish. I think the first quarter FY23 results, which were announced very recently, most of the companies have delivered strong numbers when it comes to growth, and also the asset quality numbers have been fairly benign. Therefore, profit growth have been very strong. I think this trend would continue for the remainder of the year. Also, what I mentioned earlier is that we believe next 2-3 years could be very strong years for or the rebound years when it comes to banking and financial services sector at large.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.